Every November, founders and VCs gather in Helsinki to ring out the Old Year at Slush, which bills itself as the most founder-focused event on Earth. The theme for this year is metamorphosis, which comes from Greek and literally means change of form. There's been a lot of change in the world recently, but nothing has come close to the AI gold rush started by ChatGPT 2 years ago. For the first time in a long time, we've seen a new generation of companies and founders really challenging the big tech status quo, and with them promises of a revolutionary future. But along the way, we've also forgotten that most people struggle with change, and that when change happens too fast, we often can't discern what was once familiar to what's new. Take valuations, for example. Traditionally, we used to measure companies by their multiple, calculated as the company's valuation divided by its revenue. Multiples used to be a safe metric for investors to compare a company to other businesses. For example, the price-to-earnings (PE) multiple is still a common way to value the stock of listed companies. But with the AI companies of today, using multiples is no longer an option because, for many of them, they create a distorted picture of their true worth. The reason is simple. Many AI companies are now built on hype and raise enormous sums of capital early in their life cycle, often before achieving meaningful revenue or product-market fit. This leads to astronomical multiples, sometimes exceeding 100 or more. Take xAI. The Wall Street Journal reported this week that it is raising $5 billion in a new funding round, valuing it at $50 billion with just $100 million in revenue. Based on these numbers, xAI would have a multiple of 500x. While this might sound exciting to some, it should raise red flags. High multiples signal either immense confidence in future growth or an over-reliance on storytelling and speculative potential rather than substance. Contrast this with AI companies that have focused on building robust products and generating stable revenue. These firms often have far more reasonable multiples, 20 to 30x, reflective of solid fundamentals rather than hype. The media has a role to play here for sure, as reporters shape how AI companies are perceived. Startups often thrive or falter based on the stories told about them. A glowing profile in a major outlet can fuel additional fundraising, partnerships, and customer interest. When the media fails to scrutinize the actual business performance of AI companies, we get into a vicious cycle. First, hype-driven companies attract more capital. Then, that capital inflates their valuations, leading to even higher multiples. Finally, the inflated valuation is then reported as a sign of success, further driving interest. We can see this playing out in the US, where startups have raised 3x the amount of European VC overall in 2024, but 5x the level of AI investment. Even in a good year, with mega rounds for Wave, Helsing, Mistral, and Depol, Europe trails by a distance. Meanwhile, companies with real proven products can struggle to break through the noise. Without the inflated valuations to grab headlines, their genuine achievements are often overlooked. The AI industry isn't the first to face this problem. During the dot-com boom of the late 1990s, countless internet companies achieved sky-high valuations based on little more than the promise of future growth. When the bubble burst, only a fraction of those companies survived. Those that did, like Amazon or Google, were rooted in real business fundamentals. The main difference between the dot-com years and today's AI era is just how capital-intensive the startups are. If you're building foundation models, you need hundreds of millions of dollars just to play catch-up with OpenAI's technology. We should celebrate founders for sure and acknowledge the transformative potential of AI, but we should also be clear that not every company will succeed. And the ones that do are more likely to have good answers to the following 4 questions. 1. Let's start with revenue growth. Is the company generating significant and growing revenue from a diversified customer base? Second up is customer adoption. Are real businesses or consumers paying for the product, and are they renewing? The third one is about operational metrics. How efficient is the company in scaling its operations? What's its path to profitability? And the fourth is technological differentiation. Does the company have a genuine technological advantage, or is it repackaging existing capabilities? By adapting the way we use metrics in tune with the times we're living in, we can better navigate the next waves of change that are about to come. And now, here are the week's headlines. Much of the discourse around artificial intelligence involves its potential to displace millions of jobs. But AI offers a surprising upside too. It could make life cheaper, especially for many of the professionals who most fear it, according to Kartik Hosanagar, a professor of technology and digital business at the Wharton School of the University of Pennsylvania. He says that from 2004 to 2023, private university education costs in the US rose by 40% when adjusted for inflation, with public university costs increasing even more steeply. AI can address these rising costs by enhancing the efficiency of student services. An AI system, for example, could analyze a student's academic records and suggest personalized career paths, allowing career counselors to focus on providing tailored advice rather than data collection or routine counseling. The coming wave of artificial intelligence usage won't just strain data centers and power grids, it will also stress the country's network capabilities. That's because more people will use AI chatbots and agents, which will talk in turn to still more AI agents. And all that requires more data, computing, and back-end technology systems like networking. Networking is considered the plumbing that moves data and applications inside and between data centers, as well as between data centers and internet-connected devices. Artificial intelligence has already proved that it can sound like a human, impersonate individuals, and even produce recordings of someone speaking different languages. Now, a new feature from Microsoft will allow video meeting attendees to hear speakers talk in a different language with help from AI. Microsoft unveiled Tuesday a new AI interpreter that can simulate speaker voices and offer near real-time voice interpretation in 9 languages on Microsoft Teams, the company's communications platform. The feature is being tested by a limited group of users and is expected to be more broadly available in 2025 for accounts with a Microsoft 365 Copilot license. Fortune magazine says Llama could be a pivotal chapter in the ongoing philosophical debate between open-source AI models, generally more transparent, flexible, and cost-effective, but potentially easier to abuse, and closed models, often more tightly controlled but lacking transparency and more costly to develop. Just as crucially, Llama is at the core of a complete strategic pivot on the part of Meta to go all in on generative AI. Mark Zuckerberg is now seen as a champion of democratizing tech among Silicon Valley developers, just 2 years after he and his company were being questioned and sometimes mocked for going all in on the metaverse and vilified for having contributed to political polarization, extremism, and harming the mental health of teenagers. Business Insider is reporting that Amazon has faced repeated delays in launching a new AI-powered Alexa. Integration with partners like Uber and Ticketmaster has complicated troubleshooting processes, with latency and compatibility issues also causing delays. One of the main challenges facing the new Alexa relates to how the digital assistant will interact with other companies and services, and who is responsible for customers if their requests, orders, and payments don't go smoothly. Silicon Valley's venture capital firms are having an easy time finding promising startups to back. The hard part is cashing out. According to the Wall Street Journal, last year U.S. venture firms returned $26 billion worth of shares back to their investors, the lowest amount since 2011, based on the data provider PitchBook. Startup investors say 2024 has continued the trend, with high levels of investment and few acquisition deals or initial public offerings. U.S. venture firms invested $60 billion more than they collected, the highest such deficit in PitchBook's 26 years of data. As a result, the investors that back VC firms, such as university endowments and pension funds, aren't seeing the type of profits the industry has long delivered. OpenAI ranks 4th among top vendors that IT leaders are currently or planning to spend the most with next year, according to a newly released industry report. Flexera, a software asset management company, released its 2025 IT priorities report based on a survey of 800 IT leaders from the US, the United Kingdom, Germany, and Australia. The survey focused on how IT decision-makers will make priorities for the coming year. Generative AI has been eagerly adopted in the productivity tech space, with new and existing tools promising features that can help streamline your schedule, simplify emails, and take notes more effectively. In an article for The Guardian, Victoria Turk says she had generally been skeptical of such products, assuming that by the time she'd fiddled around to get them set up, she'd probably negated most of their productivity benefits. But with a new generation on the scene, she wonders if her workflow couldn't benefit from an AI boost. Xavier Neal, one of Europe's top technology investors, believes the region can succeed in creating leading artificial intelligence companies even without the billions in capital raised by US competitors, as long as founders are not tempted to cash out too early. Europe can create competitive AI models today, he said in an interview with the Financial Times. But over the next 2 or 3 years, success depends on the number of initiatives and the ability of those who are the real geniuses, those building the best companies. not to be swallowed up or to sell too quickly. Such optimism about European tech is notable given that the continent lost to US and Chinese giants during previous waves of disruption from the internet to social networks, leading the region to distinguish itself more on regulation than innovation. On Wednesday, Fortune released its second annual Fortune 50 AI Innovators list, highlighting the AI companies that are leading in this new phase of the technology's adoption. They're the vendors that have gained the most traction, such as funding or customers, and whose AI is considered to be among the best of class. In addition to OpenAI, the big tech companies on the list include Microsoft, chipmaker NVIDIA, business software firm Salesforce, and Chinese e-commerce juggernaut Alibaba. Among the startups are voice cloning tech company 11 Labs, French AI chatbot upstart Mistral, China-based AI company ModelBest, and biotechnology company Zera Therapeutics, all of which are less than 3 years old. Business spending on generative AI surged 500% this year, hitting $13.8 billion, up from just $2.3 billion in 2023, according to data from Menlo Ventures released Wednesday. OpenAI ceded market share in enterprise AI, declining from 50% to 34% per the report, while Amazon-backed Anthropic doubled its market share from 12% to 24%. Building the current crop of artificial intelligence chatbots has relied on specialized computer chips pioneered by NVIDIA, which dominates the market and made itself the poster child of the AI boom. But the same qualities that make those graphics processor chips, or GPUs, so effective at creating powerful AI systems from scratch make them less efficient at putting AI products to work. That's opened up the AI chip industry to rivals who think they can compete with NVIDIA in selling so-called AI inference chips that are more attuned to the day-to-day running of AI tools and designed to reduce some of the huge computing costs of generative AI. Niantic has announced that it's building a new large geospatial model that combines millions of scans taken from the smartphones of players of Pokemon Go and other Niantic products. This AI model could allow computers and robots to understand and interact with the world in new ways, the company said in a blog post. A program called AVGen, or Automatic Video Generator, silently monitored the live feed of the Boston Celtics in their season-opening showdown with the New York Knicks last month and cut each play into a ready-for-social media clip in real time. From blocks to buzzer beaters, AVGen filed them all away, complete with metadata recording who did what, when, and how exciting it was on a scale of 1 to 5 stars. According to WSC Sports, the Tel Aviv-based SaaS company behind AVGen, the Celtics made their X-Posts with the help of AVGen. In fact, the company says that every individual team in the NBA, as well as the league itself, licenses the technology. Thanks for watching. This is an AI-generated video readout of this week's Computer Speak newsletter. To keep up to date with the latest news in AI and other emerging technologies, subscribe to Computer Speak on Substack.